Let's have a look at our agenda this week. We are going to start with a review of the economic data from last week. Covering rates and yields, real yields and OAS like we always do. Have a look at our upcoming economic calendar. A closer look at just the level of U.S. debt that exists. Typical tour of SPY and the earnings we should be aware of this week. And our spotlight companies, Fluence and EOS. And a dive into understanding energy storage. If you like what you see, let's see if I can do this rightly. There you go. There is a thumbs up for a like and S for subscribe. Let's head in. We'll start this week by reviewing last week's economic calendar in the US and a little bit of Canada. Canada had a wicked jobs report. And we'll have a look at the effect on the dollar. We had ISM manufacturing and services last week. It's private data, so it's up to date. It's for the month of November. Manufacturing, following in the footsteps of all the other ones we've seen over the months. Nothing to see here except disappointment. The PMI number 48.2. Last month was 48.7. The expectation was for 48.6, came in lower. For employment, came in much lower, 44. Anything under 50 is considered contraction. New orders, 47.4, came in much lower than 49.4 because, of course, you're bringing manufacturing back to the U.S., so we would expect to see employment lower, new orders lower, and the PMI lower. Wait, did I get that right? If you're bringing it back, well, you see where I'm going. And prices, 58.5 versus 58, lower than expectation. The tariffs affect goods coming into the country, not services. So if we're going to see any pricing pressure, it will be in manufacturing more than services because it's more likely that you're importing goods. Heading over to services, came in better than expected, but just slightly, 52.1 to 52.6. Last month was 52.4. Anything over 50 is expansion, so it is still expanding in a slightly better way. Business activity, 54.5. The month before was 54.3. Employment, 48.2 to 48.9. Still under 50, but not contracting as much as it did the month before. New orders, that's sort of the negative spot here. 56.2 dropped to 52.9. And look at prices paid from 70 down to 65.4. So ISM services prices paid came in lower than it did the month before. For manufacturing, came in slightly higher the month before, but lower than expectation. I'm going to talk about inflation on the next page. And that I sort of think we're thinking about it wrong. ADP employment, look at that, negative 32. The always wrong, but the only data we have now is the always wrong ADP. This is for November, negative 32,000. And Challenger job cuts, 71,000, up 24% year over year. It is the highest November since 2022, and only above 70,000 for November. It's only been above 70,000 twice since the great financial recession, 2008 and 2022. And here we are over 70,000. Not only that, here's another statistic from the job cuts report. 8 out of 11 months, because this is November here, 8 out of 11 in 2025 were higher than in 2024. Beyond job cuts, you also have job announcements, new job announcements. Hiring plans announced year to date, 497,151. That is down 35% over 2024. So your layoff announcements are above 2024. Your hiring plans are below 2024. This is the lowest level since 2010, by the way. Lowest level in 15 years. 372,520 of these are seasonal. And this, for seasonal workers, is the lowest level since tracking began. Let's look at initial jobless claims. That was on the previous screen, but I needed the Fred chart to make a point here. Initial jobless claims came in at 191,000. There it is, way down there, sort of just falling off the chart, meaning 191,000 people filed for initial jobless claims. So what I've done is I've circled the area between October and December of each year, October and December, and you can see that they do fall into the end of the year. You can see how low it was here, pretty much the same thing here. And then here we're falling into the end of the year. You see the lows over here. This is quite normal. It is considered bad form to lay anyone off in the period between Thanksgiving and Christmas. That if you're going to make any cuts, you try to get it done before then, or you do it after in January, but certainly not at that time, just because of the potential for litigation and just the bad publicity you get from that. So this is seasonally quite normal to have this. You see it, they rise into the middle of the year and they fall into the end of the year. They rise and then they fall, they rise and then they fall. This is a typical pattern. So I don't know that I would look at the 191 and say everything is okay. However, ZQ decided to say, well, we're certainly not getting rate cuts now. And out the door went the ADP number of -32. Out the door went the ISM manufacturing employment of 44 versus 46. Out the door went the ISM services employment number being below 50. And then we ignore continuing jobless claims sitting just under 2 million. What we have, or what we've seen over the last little while when we look at job creation, is we're basically at zero on job creation. People are not losing their jobs because initial jobless claims are not elevating, but you have continuing claims sitting at about 2 million. And that is not coming down because we're in a no job creation economy. Look at Canada though. Look at the unemployment rate was 6.9. The expectation was for 7, dropped to 6.5. Two big reasons here. You had employment, 53,000. We're 1/10 the size of the U.S. So if the U.S. were going to report, just to give you an idea of the magnitude of this, it'd be the same as the U.S. reporting 536,000 jobs on a non-farm payrolls report. You'd say, oh, that is huge. So for Canada, that's pretty big. The mix, I guess we can, if you want to look for, the gray in the cloud, here it is. Full-time dropped, part-time increased. What did the heavy lifting in getting from 6.9 down to 6.5 is the participation rate, 65.3 down to 65.1. You can always get your unemployment rate down by convincing people to leave the labor force. By just saying, what's the point? You're not going to find anything anyways. You should just give up. And then you interview them. They say, I'm not even looking. I've given up. Well, then you're not unemployed. Thank you very much for helping us out. Well, did this ever affect the currency? If you join us for the live morning sessions on Discord, I always start by looking at currency, saying, if there's anything out there, it's going to show up in the currency first, and it certainly did. The Canadian finished that day at 138.18. That is a drop of 140 basis points, 1%. Usually a currency, anything greater than 0.5%. There's something there to pay attention to. This was a big move, 140 pips in one day. We have the Bank of Canada in 3 days. This almost takes the rate cut, any rate cut, off the table. More than likely that you'll see the Bank of Canada on hold. More than likely that you'll see the Fed cut, which means interest rate differentials will narrow in Canada's favor, favoring the Canadian dollar, and there it is, 140 pips. Then we have, back to the U.S., core PCE. Came in as expected right on the nose. 0.2 came in at 0.2. Last month it was 0.2. Doesn't get worse, doesn't get better. The price index month over month up 0.3. The expectation was for up 0.3. The last month was for 0.3. This is headline, came in right as expected. Year over year, 2.8. This is headline. Expectation was for 2.8, came in right as expected. And core came in at 2.8. The expectation was for 2.9. Last month was 2.9. So core has dropped down. And in response to this, the market went, oh my God, we're never getting a rate cut. ZQ just backed right off, while Bloomberg kept saying the market is pricing in more rate cuts. I kept saying to myself, what are you looking at? Because that's not my experience. I have well over 400 contracts on this now, and the pain, dear God, the pain on Friday from this, the market just responded, fixed income just responded to this saying, oh my God, it's never going to happen again. How can you possibly lower rates? I'm going to say something shocking here. Rates have nothing to do with inflation. The interest rate could be 10% right now. Well, actually, I shouldn't say 10%, but you can go 100 basis points higher, 100 basis points lower. It will not affect the price level. It will not affect the level of inflation. That sounds like a shocking statement. For this, we have to go back to the 1970s. This is a good lesson. I've made this case before. We attribute the big drop in inflation at the end of the 70s, early 80s, to Paul Volcker. He raised rates so much, he crushed the economy, and he got rid of inflation. If that was all that was going on, you would say, okay, well, that makes sense. But there was this other big thing going on all through the 70s. It was regulation. The 70s was known as a decade of regulatory boom. You had whole industries that were already very highly regulated, and then there was more regulation layered in. Over 20 new regulatory agencies showed up in the U.S. during the 70s. It was also a decade of technological stagnation because of regulation. Well, regulation raises costs. Just to give you an idea that the extent of the regulation, airlines, highly regulated on the fares they could charge and the routes that they could travel. You couldn't just start an airline. No way, no entry. So there was no pressure for prices coming down because you restricted supply. Trucking and rail, you couldn't just enter that industry. Supply was very tightly controlled, and so were prices. And when prices are controlled, when you put price ceilings on something, you actually limit the supply. Telecom, there was only AT&T. You couldn't just enter that industry. Energy, highly regulated with price caps. Nixon put price caps in. Well, again, you want to constrict supply, put in price caps. Banking, highly regulated. Think about this for a minute. Transportation, in terms of airline, trucking, and rail, regulated. Communications, regulated. Energy, regulated. Banking, regulated. How are you going to get anything done? It was a decade where the word entrepreneurship was attributed to failures. Oh, you couldn't get a job, so you're going to start your own and call yourself this French word, entrepreneur. It had no credibility to it whatsoever. Innovation was about going sideways. The 70s had one big problem, and it wasn't inflation. Inflation was the symptom. The 70s problem was supply. Was you had a government doing the best it possibly could to limit supply. Whenever you limit supply, you're going to get inflation. So what happened when Reagan came in? Massive deregulation. Warnings about, oh, you're going to destroy whole industries if you do that. You'll destroy the airlines if you deregulate. You'll destroy trucking if you deregulate. You'll destroy everything. And what happened? Supply increased dramatically and prices came down because you had more choice. The more supply drives down price. At the same time that Volcker was raising rates, you did not have to crush the economy to get that done. You just had to deregulate. Well, this is the problem we're having today. If prices are not coming down, that is not too much demand. That is too little supply. You have to increase supply. Paradoxically, higher rates keep supply down because it is expensive to carry inventory. It is expensive to invest to build inventory. It's expensive to build a bunch of houses in inventory, spec houses, so you have a lack of supply there, keeping prices high, higher than they need to be. This is not, the inflation we have right now is not a central bank issue to solve. Whether rates are 0, whether rates are 6%, it doesn't matter. It's about supply. You have to find a way to increase supply. However, this administration seems to be doing everything it can to repeat the 70s. Let's keep immigration to 0 so that the supply of new labor is flat, if not shrinking. Let's shrink the supply of that. Let's make sure that goods coming into the country slow down a lot. Let's shrink the supply of that. And we'll even put tariffs on stuff we can't even make ourselves. Let's shrink the supply of that. They're doing everything they can to shrink supply because, wow, this is not an educated group of people, I think. I shouldn't say educated. They're not an informed group of people. And all deference is given to the central bank that it's the interest rate that will solve the inflation problem, but it's the interest rate that perpetuates the inflation problem by keeping supply down. Look, we had near zero or zero rates basically from 2009 to 2020, except that little period of time when Powell did raise rates and then had to run very quickly back to the zero line. Where was inflation? In fact, for a while, with Yellen, there was a concern about deflation, and rates were 0. With quantitative easing, by the way, pulling that yield curve down, there was still a concern of deflation because there were no supply constraints. You shut down the global economy in 2020 and created supply constraints. And not only that, you did a very bad thing, or the U.S. did. Well, I guess they had no choice. If we think about GDP, GDP is the amount of goods and services produced in the economy within a period of time. In macro, there is an identity that it also equals the level of income. This is why you have the saying, supply begets its own demand, because if you hire people to build stuff, you give them a wage with that which they can then use to buy the very things, the very value that they create in the economy. GDP equals GDI. So what happened when you shut down an economy, GDP is going to drop. However, if you start giving people money, you have a separation between the income produced by the output. You have more income than output. So obviously prices are going to go up. And then the central bank raised rates. But what happened at the same time? The economy opened up, supply chains healed, supply came back online, and prices came down. We think it's the interest rate, but it was supply just coming back online. In fact, had the central bank done nothing, I think they would have been right in the beginning by saying this is transitory. All inflation is transitory. The best cure for high prices are high prices if you have an industry that allows entry. If I can start a business or increase my production in response to pricing signals, you'll get prices down. And we're going to see this with NVIDIA. You have more companies making chips, ASICs now, that will do a very specific task, but that can replace the need for NVIDIA chips, which will lower the price going forward. Because when you have a company with those kind of gross margins, it's going to attract other entrants, unless it's regulated and you can't do it. You get that? So the administration, over the next year in 2026, if they really, really want to solve inflation, stop yelling at the central bank. You can get the central bank to lower rates by lowering inflation yourself, by removing regulation everywhere, getting rid of a whole bunch of regulation that does little more than raise costs. And you'll lower inflation, and you'll give the central bank permission to cut rates, and you'll leave them thinking that they are engineering an economy when they are not. Well, let's look at the effect of all of this on rates and yields. The expectation is for a cut coming up on Wednesday, and money market rates are reflecting that. The 1 month down 23 basis points to reflect next week's cut. The 2 month down 22. Long end of the curve having nothing to do with it, saying, nope, we're going to go the other way. And this is where credit is priced off of. Credit for banks, their funding is priced off of these rates. So that is bullish for banks. We see the KRE over here up 2.75% for the week. It beat all the indexes. It beat large cap, small cap, and tech handily, easily. Beat TLT, easily beat the dollar, one of the best performers last week, because their funding costs are going down. However, consumer borrowing costs are going up. Look at the 10-year, up 12 basis points to 4.14. That is the basis for mortgages, is some spread off the 10-year. The 5-year up 13 basis points. That is the basis for car loans. Although sometimes it's the 7-year, that's up 12 basis points, not to be outdone there as well. So the thinking is, well, if you lower rates with inflation elevated, you're only going to make inflation worse. And especially if the Trump administration is going to send everybody a whole bunch of money, which is the stupidest thing. I don't know that you can get more stupid than that, but Trump is not really doing that for the economy. He doesn't really care too much about that. He's doing it for power. He doesn't want to have to answer to the Democrats when you get to the midterm popularity contests. So he wants to buy affordability if he can't get affordability. I think this will just make him more motivated to put somebody in the Fed in a way, and it's a fine line to walk, in a way that the market accepts the person, but at the same time, that person is motivated to get rates down 100, 200 basis points over the next 12 months. Because you got to win those midterms. He will not answer to a Democrat and doesn't want them Democrats blocking his agenda. Slopes increased week over week. The 2 to the 10 at 58. The big news here is 29 basis point increase in the 3 month to 10 year. So my forecast for the 3 month to the 10-year slope by the end of 2026 is 100 to 125. We just moved 29 basis points closer to that, and 3 basis points closer to the 75 to 100 for the 10-year. The effective federal funds rate is currently at 3.89. I think by this time next year will be 2 to 2.25. And next week we'll move 25 basis points closer to that. And our 10-year 3 to 3.5, we're at 4.14. This is a target of Besant, and he wants the Fed and the Treasury to work closer together. By the way, the decision for the Fed chair has been delayed till the beginning of next year. All the interviews that Besant was going to do have been canceled. Trump has made up his mind, and you have 3 people involved. You have Besant, you have Hassett, and you have Mirren. Mirren is on the Board of Governors right now, apparently to be replaced in January, and whoever the Treasury Secretary is going to be, the Fed chair is going to be, is probably going to be put on the board. So the thinking is this replacement is going to happen. And you have Hassett in there. But I would not be surprised. I would not be surprised if Besant becomes the Fed chair, and either Hassett or Mirren go to Treasury. I would not be surprised, because you need someone who is willing to get their nose as far up Trump's ass as possible. And Marco Rubio is already Secretary of State, so it can't be him, and he won't get out of the way. But Bessent is a close second. He gets his nose up there quite a bit when Rubio's not looking. This troubles me. Okay, so we're expecting inflation. Then I expect that if I go to the break-evens, I would see the break-evens up that high, that the market is pricing in much higher break-evens, but they're not. You go to the 10-year, they're pricing in 3 basis points higher, but the 10-year is 12 basis points higher. So you got 9 more basis points on the term. And that could be just because of the sheer amount of debt, the stupid statements coming out of the administration, and it seems the almost unwillingness of anybody in government to even acknowledge that this should be taken care of. We're going to have a look at the level of debt in a couple of screens here. Let's look at Fed funds futures, because they did not treat me well at all. Effective federal funds rate to 3.89, up another basis point over last week. We've gone from 3.838, 4.858, all the way to 3.89. 6 basis points higher. It has creeped. It should be 3.83. It's 3.89. I say 3.83 based on where 25 basis points cuts would have gotten us before stress in repo markets. Small stress, but stress, and here we are 6 basis points higher. So that puts me 6 basis points behind, because now I need rate cuts as I anticipated, plus another 6 to overcome the drift. What are we expecting in Q4? 24 basis points, and I think that's a lock. That looks like it's probably a done deal, 24. I shouldn't say a done deal. You never know what's going to happen, but there it is. There's only one meeting left this year, and there it is. But then indecision, Q1, 60%, Q2, 80%, Q3, 60%. So looking at 73 cuts across all of these, all the way to the end of next September 30th, 73 basis points. That's 7 meetings. 3 cuts in 7 meetings. We're going to get 1. So we're basically saying there'll be 2 in 6. And of these 6, 3 are with Powell, 3 are without Powell, and we're looking at 2. It seems that the market on this one is either I'm way off or the market is completely wrong. The market, I think, is still pricing in a rational, independent Fed and thinking that Trump will keep his hands off of that and the Fed will be independent and will respond to its dual mandate. I, on the other hand, say no. April, go out to April 2027. 96.955, implying 3.045, and there's some thinking that 3 to 3.25 is the terminal rate. That is terminal rate, 84.5 basis points, 11 meetings. That's about 3.5 cuts in 11 meetings. 7 of those meetings are without Powell, and we're going to get 1. We're going to get at least 1, so we're really at 2.5 in 10. 2.5 cuts in 10 meetings. Look at where the job market is right now. And we really haven't even seen the full extent of what AI can do. We haven't even seen that yet. And look where it's come since I started sitting up and noticing how good it got early this year, April. When I revisited, I thought, whoa, this is really different than the year before. And where it is today versus April is a magnitude of improvement as well. Where are we going to be in 6 months? And this is all we're going to get. I see a big problem here. I added to my ZQ position for October ZQ. I now have 342 contracts. For the December ZQ, I now have 50 contracts. And for the April 2027, I now have 60 contracts. I have 452 contracts. Every basis point hurts. So Friday was not a good day. Well, let's have a look at the effect on real yields. They all went higher, and break-evens went slightly higher. So the prospect of lower rates mean higher real yields. I'm trying to get my head around that. You had a lower dollar but higher real yields. Lower US dollar will drive up precious metal prices, but lower real yields will drive them down. Gold is showing that indecision, up 60% year to date, but gave back last week. But silver, that's a momentum trade now. 3.55% on the week, up 100%, 102% year over year, or year to date at least. Sorry, not even year over year, year to date. 102% being the big winner. Oil up 2.65%, but still down 16% for the year. Nat gas firmly over $5. Look at that week. It had 8.85, 45% year to date. Got a 5 handle on it now. I wouldn't be surprised to see 6, 7, 8 handle by the time you get to end of January, mid-February. The expectation is for a much colder winter than normal. And you have huge nat gas power draw for data centers. So I would seem to think that continues on. Looking in the food complex, wheat, corn, soy, wheat up, corn up, and soy down, but sort of mixed for the year. We have a Fed meeting in 3 days, and we get summary of economic projections. That's gonna. I think this will be the more interesting story, is the summary. 87% probability of a cut, down from, up a little bit from 86.9, 87.2, and 12.8. If we go to January, a cut in December, followed by a cut in January, 25% up from 22%, and one cut, whether it be December or January, 65.8. Down from 66.6, and nothing, 9.1, down from 10.7. The weight moving towards 50 basis points. Reverse repo, 1.4 billion, under a billion, 905 million on November 18th was the lowest number. Repos, 0. December 1st, it was 26 billion. December 1st, I can see going into the end of the month they elevated, but December 1st, 26 billion, then it dropped to nothing. Reserves 2.8 trillion. What is going on here? Look at the TGA, still at 908. Are they not going to pay anyone? Like, are they just not going to pay anyone? That should be falling towards 750, which is the target set for the TGA. It should be falling towards 750, which means that 150 should head over into reserves, because it's going to end up in somebody's bank account somewhere along the lines. MBB, mortgage-backed security ETF, down for the week, but still for year-to-date 3.77 plus that yield. Both agency and Annaly had a good week. Agency beating the S&P. S&P was up 0.34. IWM small caps 0.81. Tech, triple Q, up 1.01. And agency beating them all, up 15% year to date, plus that big fat dividend yield. Look at Annaly, 25% plus another 12 on the dividend, just sitting shy of 40%, easily beating Nasdaq, easily beating small cap and large cap, easily, but certainly not silver. And Nat Gas beat that out as well. All these little quiet corners. Look at this. OAS pulling back. Don't want that government debt, but we will take that corporate debt. About all the talk about corporations issuing more and more and more debt to fund all the AI growth, and look at the pullback in all those yields. Even triple C, even stuff which is highly questionable. 30-year treasury is not. highly questionable. Still a contraction of 38 basis points, bid up to the extent of saying we'll take 38 basis points less than last week for this stuff. We certainly have different markets, and I don't think these people are talking to each other in all of these different markets and sharing notes, because I think many of them would say, but hang on a second, your move is contradicting my move. How can this be? 30-year fixed rate mortgage, 6.19. I have here the Fed governor projections for 2026 and 2027 because we are going to get a new SEP. The median is 3.38 for the end of 2026. There are 9 meetings between now and the end of 2026, and this is saying as of September, they saw 2 basis point cuts to the end of 2026. In other words, we get one in December, which we think we'll get one in Wednesday. And as of September, they were thinking there'll only be one more for all of 2026. If you go out to the end of 2027, you have 76 basis point cuts from where we are now. If you're getting 51, 1 to end 2025, 1 to end 2026, this is saying that by the end of 2027, there'll be one more. In other words, 3 cuts in 17 meetings. So the SEP, I think, is going to be super interesting to watch. The other reason that I think it behooves, you like that word? Behooves. It behooves the central bank to start moving towards the zero line is the sheer amount of debt and the unaffordability of the debt and the unwillingness of the politicians being elected in these popularity contests to do anything about it. If you have the ability to pour yourself a stiff drink, I would recommend you hit pause. Do that now, because the next screen, if you are American, is going to be unsettling. Let's take a quick look at our economic calendar for the week coming up, but I think we all know what the big risk event is. We have nothing on Monday. Tuesday, we get the ADP employment change, the weekly change. We also get JOLTS, September and October. Looks like we're going to get them at the same time for September and October. And you have the WASDE report, which is a big deal if you're into the grains. Heading into Wednesday, you have Bank of Canada in the morning, 9:45, and you have the Fed in the afternoon. We do have the employment cost index out at 8:30 for Q3. And then, of course, you have the press conference at 2:30. Going into Thursday, we have some lagging data from September, balance of trade, exports and imports. You'll get the initial jobless claims every week, continuing jobless claims. Not much left to see here. Do we have any big auctions? 30-year bond auction. On Thursday, we got a 30-year bond auction. Let's see how that goes. Japan's 30-year bond auction last week went quite well. All the concern about rising yields, had a bond auction, went quite well. You want to get more demand for your bond, have a higher yield. We're at 4.69, 4.7 on the 30-year. Let's see how that goes. And then going into Friday, we don't have very much, but the Fed speakers are going to be hitting the trail very quickly. You have 2 by the end of the week. This is a screen of nothing but debt, government debt, and at the very bottom, we'll look at some corporate debt. Let's start with interest expense and average interest rate. This is the average interest rate on the U.S. debt, 3.348%. That's the dotted line that you see over here that's now flatlined across the top. These bars are interest expense. This is 300 billion, 600 billion. We see it was under 600 billion, and then it just exploded. We're at 1.2 trillion per year. Budget deficit of close to 2 trillion, 1.8 trillion, 1.2 trillion of that is just the interest expense, which means at this point the interest expense is adding to the principal, so that next year you're going to pay interest on the interest. And the year after is interest on the interest on the interest, including a growing principal, because, well, we don't elect good people, we elect popular people, and popular people get elected by promising to spend money, and spend money they do. U.S. has a fiscal year that ends September 30th. So this 1.2 trillion, that was the end of fiscal year 2025. October 1st started the fiscal year 2026. As we see here, we're already at 201 billion. That's about 100 billion a month. On track for another 1.2 trillion, which will just add to the debt. This is a pretty sobering picture here. This is U.S. national debt over the last 100 years. Inflation adjusted in 2025 dollars. So here we have lots of responsibility per post World War II to about mid 80s, and then up we go. We can see from 2021 adjusted for 2025 dollars, 33.6 increased to 37.64. It's okay to have debt. Let's say that I make $100,000 a year, and I have $50,000 in debt. My income is 2 times my debt. If I'm making $2 million a year and I suddenly owe $750,000, even though my debt is 15 times higher, this is greater than 2 times. My income is now greater than 2 times my debt. It's more affordable. So we would want to divide debt by GDP. Here it is here. For ending fiscal year 2025, September 30th. This is responsibility. And then we just abandon it. 125% debt to GDP. 125. At 100%, you need your GDP growth rate, keeping tax rates constant, your GDP growth rate to equal your average level of interest rates. At 125%, it has to be 25% greater just to stand still. So you got 3.348. So we're looking at about 4.25%. If it were 25% higher, I think a little bit more than that, 4.4. 4.4% average nominal GDP growth just to stand still, so that it doesn't get any worse than 125%. But if you're lowering taxes, you need an even higher nominal GDP growth rate. If you're spending more money, you need an even higher nominal growth rate. At this point in time, the U.S. does not have that. Once you factor in the tax cuts, if you are going to write these $2,000 checks, that's all gone. Which means that there probably is no nominal growth rate that's going to make sense. The U.S. right now, and I'll agree with Powell on this, is on an unsustainable path. Period. It is unsustainable. You're going to hit the wall at some point. The level right now can be dealt with, but the path that the U.S. is on is unsustainable. One thing that can be done very easily is to get the average interest rate down. If you can't get the level of the debt down, you can get the average interest rate down, which is what Besson seems to be trying to do by concentrating issuance in T-bills, hoping that rates will be cut down to about the, sub 3 level, maybe down to the 2% level. And if you can concentrate and keep rolling over your T-bills, the majority of your debt in T-bills, you can ride that interest rate down. It is necessity at this point. It's not manipulation. It is pure necessity. You have no choice. It is necessity. Let's look at intergovernment holdings. Held by the public at the end of 2025, 30.77. By the time you get to December 4th, that's 30.824 trillion held by the public. 7.62 intergovernmental. Still debt, because you still have to pay interest on it. It's now 7.565. So that's actually dropped a little bit, and this has actually increased a little bit. This is 2015. 5.24 is now 7.62. 13.59 is now 30. You're talking over 200% increase over 10 years. Unbelievable. December 4th, the total debt is 38.3894 trillion. Average interest rate of 3.348, which we get from up here. Your forecast for your interest expense is almost 1.3 billion by the end of 2026. somewhere in 2026. I wouldn't even say the end of 2026. This will pass $40 trillion. Something has to be done. Something has to give. Now, it seems to me that with the money that you're raising from the tariffs, if you're going to give it away, if you're going to spend it, wouldn't this make a lot more sense? Go over to Social Security and say, instead of holding U.S. Treasuries, you can hold investment grade bonds, because instead of the taxpayer paying the government so that the government can pay interest to Social Security, let the corporations pay it. Put in investment grade bonds instead of treasuries. Take that money that you would give out, go over to Social Security, buy back $200 billion worth of bonds, and then Social Security can go buy $200 billion worth of investment grade securities, get a spread that's about 100 basis points higher, or if they want to be really safe, they can go for 50 basis points higher than what they're getting now, and have the corporations pay into Social Security instead of the government paying into Social Security. The government immediately starts to save interest on $200 billion right away, and corporations start paying that the interest on that $200 billion, and Social Security gets 50 to 100 basis points more in yield. Duh. However, that's not going to get you any votes, and you can't let them Democrats win. This is not about you. This is not about the country. This is not about responsibility. It's about power. It's about selfishness. And that's why this is not going to improve. That's why you need the adults in the room, the Treasury and the Fed, to do what needs to be done. Let's look at corporate bond issuance. That is elevated as well. Year to date, up 8.8% in corporate issuance in November versus last November. Almost double. Investment grade went from just under 100 billion to 142 billion. High yield went from 13 billion, more than double, to 28 billion, almost 29 billion. Convertibles, 7.9 billion to 11.64 billion. Debt everywhere you look. It seems to me a good deal would be take the money from the tariffs, go over to Social Security, give them that money, let them buy corporate bonds, let the companies pay into Social Security with their interest expense instead of the American taxpayer. Who's with me on this one? Let's look at SPY. Forward, 4-quarter operating earnings, $296.15. Hasn't budged in 3 weeks, and I am updating it every week. I am downloading the most current document each week and looking at stayed at $296.15. Closing SPX 68.70.40, pushing so close to all-time highs. That puts us at 23.2 times forward earnings versus 23.13. I haven't done this for a while, adjusted for the upside surprise. 2025, upside surprise of 9.5% on earnings based on the forecast, based on the consensus. Actual came in 9.5% higher. So let's say that this actually comes in 9.5% higher. It follows through. That would give you 21.19 on the forward multiple. So perhaps the market is saying, look, those are the forecast going forward, and sure, using that you'd be at 23 times, but the market's been beating that by quite a bit. So if we price in that as a standard, would only be at 21 times forward earnings, but still 23 is the headline number. And every time the market peaks above 23, it has not liked it. We have been choppy at the top here for a while. We've been going in a sideways pattern. One of the signs of a market top is choppiness, is it starts to get more volatile and choppy near the top, and it just doesn't want to exceed certain valuation levels. And here, looks like 23 has been a kind of a line in the sand, much like $90 has been a line in the sand for TLT. Peaks his head above 90 as you get down there. But we do have two very strong narratives in the market. Buy the dip in equities. Buy the dip, buy the dip, buy the dip. Don't even think. And you know what? It's been working. It's been working for a very long time. So I don't think it'll be abandoned just on the snap of a finger saying, well, let's not buy the dip this time. The market is trained to buy the dip until that is the wrong thing to do, but who knows when that's going to be. And when you get the bonds, it's sell the rips. Every time it peaks its head up, slam it down. And that's been the narrative, and it's worked. So it will continue to work until it doesn't. So these are the two narratives we're facing. 9 out of 10 days now, the S&P has gone up. 9 out of 10. 9 out of the last trading sessions, the S&P has been positive. We are now 0.213% below, hitting another all-time high and taking out the October 29th. And that really is going to matter this week with the Fed. And if we take OpenAI at their word based on their code red, in that email they sent out, they hinted at their new reasoning model being released next week, which would be this week coming up. We would get a new reasoning model from OpenAI. We're at 5.1 right now. And I got to tell you, Gemini is better. I give OpenAI and Gemini 3 the same prompts, and Gemini just gives me a much more thoughtful, deeper answer. And you know who's really come up the rear and really impressed me is Claude. In terms of doing serious work, Claude. OpenAI to me seems like more of a retail thing. And I think that if I were Sam Altman, I'd be very, very concerned because the money is going to be in enterprise, not in retail. Retail might pay $20 a month. But you're going to be an advertising company, right? You're not going to be an enterprise pricing company. You're going to be an advertising company. So I would watch their new reasoning model. It better make a leap. If it doesn't, then 2026 could be known as the year of efficiency in models because effectiveness has been proven. Effectiveness is probably reached maybe its limits, and you have small incremental improvements in effectiveness. So if we want to keep this going for another year, it has to be a significant leap over what Gemini 3 has. Volatility, just not playing along with the choppiness that we're seeing at the top of the market, saying, yeah, you know what, there's nothing much to see here. Volatility's really dropped off, which means if you're using the options and you want to buy protection, it is nice and cheap right now. But if you're trying to sell some premium, there's better places to do that. IWM on December 4th hit a new all-time high, 251.76, because rate cuts favor small caps. Look at that, 251, ended at 250.77, down 0.4 from an all-time high. The Qs, they got a ways to go, 625.48, down 1.6 off of their all-time high. We have the Fed on Wednesday. That is going to be a big deal. OpenAI, I think, is going to be a big enough deal as well. LSEG telling us 9 companies are reporting this week. Tuesday, you have AutoZone and Campbell's. Wednesday, Adobe, Oracle, and Synopsys. Oracle's a big one. Thursday, Broadcom. There's another big one as well. And Costco and Lululemon. That is going to be a big one as well, being that they've disappointed now for a couple of quarters. Is there a turnaround story in there? Every mall I go to, I look for the Lululemon store because I do have exposure to Lululemon. And every time I'm in there, I see people lined up to pay. I even went to Lululemon to buy. I was going to buy some pants because somebody said, well, they got light pants. They got nice ones. I need them for Costa Rica because these little biting midges keep biting my ankles, so I can't keep wearing shorts. I got to wear something else. $140 for a pair of pants. They didn't have anything that fit me, unfortunately. But as I walked out, I looked over at the lineup. Yes, there were people in line waiting to pay in the middle of a day. So, I'm not seeing it based on what I can see in the store. So unless their expenses are way up, let's see what they can get done. Our spotlight this week is going to be on energy storage, specifically battery storage. We're looking at Fluence and EOS. EOS because it has a competing chemistry, not because I think it is a company that is investable at this point, but it has a competing chemistry. And we'll see where it sits in the competitive landscape. There is a PDF that goes with this week called Understanding Energy Storage. It's in sector studies in the industrials. I will highlight a few points from that document in the next few screens, but if you are interested in this market, that document goes much deeper. I think it's about a little over 50 pages in length. I've got a 1-year chart of both of these up. They kind of look the same. They sort of have the same pattern. Lots of excitement since September, October, November. Over here and over here, lots of excitement, lots of IV as well. Fluence, implied volatility 104%. For EOS, 106%. So if you're looking for volatility plays, these are fun. Directional plays, I'm not sure if I think they're long candidates or short candidates right now. I don't know. But volatility is fun. Market cap 4.38 billion on Fluence, not to be outdone. EOS pretty much in the same category, 4.76 billion, making it more valuable, but you're not buying much, I'll tell you. Convertible debt, just sitting under 400 million. That is their total debt. Long-term debt here, 331 million. This is a loan. It's guaranteed. They got a government guarantee on that loan because they couldn't qualify for one on their own. And they also have a note payable, and so carrying a little bit more debt. Total shareholder equity. This tells a tale of two cities here. Total shareholder equity, 430 million. This is for Fluence shareholders only because there are non-controlling interests. So total equity is higher, but total shareholder equity for Fluence, 430 million. Sit down and have a look at this. Total shareholder deficit. This is for EOS, negative 2.32 billion. Their liabilities are greater than their assets. They are by definition, insolvent. They're not illiquid, but they are, well, when I say illiquid, internally, they have liquidity. They can continue to operate. They burn cash. They are insolvent. Fiscal year 2025, the first 9 months revenue sitting only at $56.2 million. So they, based on market cap, are trading at 66 times their revenue, 66 times, whereas Fluence revenue was almost 2.3 billion. This is 56 million. This is 2.3 billion, sitting at 1.9 times revenue. Fluence is using a very tested chemistry, which is lithium iron phosphate batteries. EOS is using a zinc bromine battery, which is untested at scale, but has claims to certain advantages, which are disadvantages to lithium iron phosphate. But let me tell you something, the history of technology is littered with the superior technology being the failure. Let's get some groundwork done in battery storage first before we dive into each company so that we can understand where each are positioning themselves. Okay, let's see if we can sort of understand the market for battery storage. We first have to motivate the need for it. What do you need battery storage for? Let's start with a problem statement for the grid. Supply must equal demand. Always and exactly. So if the demand for energy or electricity increases, supply must increase to match it. And if it drops, supply must pull off to match it. It must be in balance all the time. That's called frequency regulation. But we have a growing amount of renewables, solar and wind, which is intermittent. You can't just call up the solar farm and say, can you pull back a bit? Can you add a little bit? It produces electricity when the sun shines, and at night it doesn't. Same with solar, same with wind. If there's no wind blowing, you can't just call up the wind farm and say, look, we need a little bit more to regulate our frequency here. So why use it if it has this problem? Cheapest source of new electricity in most markets, solar and wind. And the forecast by 2035, 2 terawatts cumulative will be on the grid. 2025, as of now, we have 250 gigawatts cumulative. You're talking about an 8 times increase over the next 10 years. So we're going to find some kind of way that we can capture the electricity that it generates when it generates and then call upon it when needed. You can see that battery storage seems to be the way to go. But it kind of ruins the cost benefit, right? If solar and wind are the cheapest source of new electricity, but you then have to add batteries onto it, does it not then just ruin the idea that it's the cheapest form? Not if the batteries can produce streams of revenue that pay for themselves. Because if they're just necessary additions, then wind and solar suddenly being part of the grid doesn't make a lot of sense because of that problem that supply must always equal demand. Right? They do not respond to electricity demand. So batteries can be used for frequency regulation. When you need a little bit more, you can call upon the battery. When you need a little bit less, you can pull back in other places. And when you pull back in other places, you can use that energy to recharge those batteries. Energy arbitrage, but there is a limit to energy arbitrage. This is from California. This is a typical spring day in California. 2012 all the way to 2020. This is sort of the forecast that they had. As more and more solar hit the grid, you'd get in the middle of the day, this is 9 a.m. here all the way to 4 p.m., is you'd get a lot of electricity generation, which is going to push down the cost for electricity. So you get this big dip, and then when the sun starts setting and everyone gets home, and 5 o'clock, 6 o'clock, 7 o'clock, 8 o'clock, dinner and all the entertainment home, you had this big ramp up in other sources of electricity other than renewables. So you had this big rate difference from here to here. Well, a battery made a lot of sense because you could put your batteries on the grid and say, okay, well, when it's really cheap, we're going to load up our batteries here and then we're going to sell it over here. That's called energy arbitrage. Problem here is this. As more and more batteries start doing this, you start pushing up this part of the curve, and you start pulling down this part of the curve so that the arbitrage eventually disappears. This is a phenomenon we see in volatility trading in the market. You've got to find volatility to trade it. You need very high volatility. The best is 120, 130% implied volatility in the options with nice liquid options. But as soon as you start trading that, you're not the only one looking for volatility. There are large funds out there that are looking for volatility, and when they find it, they start trading it, and volatility is traded in a very particular pattern. You buy when prices go down, and you sell when prices go up. When you do that, you reduce the very volatility you went in to harvest. The more people that are trading that volatility, the faster it disappears, and then you got to move on. Well, this is what batteries do. It reduces that energy arbitrage. So then you get to a point where, well, isn't one of the big revenue streams going to disappear? Yeah, in time. But it is hoped that your battery will make some money by offering itself for frequency regulation, that you'll have some energy arbitrage available, and that you will get paid something for being reserve capacity, that the utility will pay you a certain fee just to have you there. This is called revenue stacking if your battery can make money in a bunch of different markets. Few terms that we should be aware of: power capacity versus energy capacity. Power capacity is measured in megawatts. Energy capacity is measured in megawatt hours. So power capacity is how fast a system can charge or discharge. It is the flow rate. Whereas energy capacity is how much total energy the system can store. You can think of that as a reservoir. So you can have a dam, let's say, with a large reservoir with a small opening. That opening is its capacity. The reservoir is its energy capacity. And we measure duration by taking energy capacity divided by power capacity. So if the power capacity is 100 megawatts and the energy capacity is 400 megawatt hours, that means that battery will run for 4 hours. That is utility grid scale batteries, 4-hour batteries, because you need them for this period of time here, about this 4-hour window here. From about, looks like we got about 4 p.m. The peak here over here is about 9 p.m. So in between this time is where you need those batteries. That's a particular type of market. And the market segments for batteries are broken down by their duration. Frequency regulation, if that's all you're going to use them for, you don't need 4-hour batteries. That's overkill. 30-minute batteries at most. For energy arbitrage, 4-hour batteries is pretty much the place to be. If you have a data center and you need backup, 4 hours might not be enough. And lithium iron phosphate doesn't do well much over 4 hours, which means you're going to need a whole bunch more battery stacks to get that done unless you move to a different chemistry. That's where EOS wants to move in, saying, listen, we can be up to 12 hours. Let's look at the market size quickly. 2025, 300 billion. The estimate by 2035 is 465 billion. The US in 2024 added 12.3 gigawatts of battery storage in terms of its energy capacity. This is the power capacity. In terms of energy capacity, that provides 37.1 gigawatt hours. And this is 2024. Expected for 2025, all of 2025, when we finally get all the numbers, that the US would have added another 18.2 gigawatts. Let's look at chemistry. Lithium ion is the dominant chemistry, or the dominant battery type. I shouldn't say chemistry, but battery type. The cost is down 90% over the past 15 years. Down 97% since 1991. LFP, this is what Fluence is using as their chemistry. Lithium iron phosphate, dominant in grid storage. About 70% of all new battery storage that hits the market, at least grid scale in the US, is lithium iron phosphate. Resists thermal runaway, which lowers your insurance costs and reduces setback distances. Long cycle life, 2,000 to 5,000 cycles at 80% depth. A cycle is a recharge. So if you're recharging it once a day, let's say it's a 4-hour battery, you're using it, you're recharging it once a day, 365 days a year, you can see that you're approaching 15 years. This is as low as 6 years, as much as 15 years, maybe up to 20 years. There's some that claim 6,000 cycles. Lower energy density versus the nickel manganese cobalt battery. And when we say lower energy density, we can measure it 90 to 150 watt hours per kilogram versus nickel manganese cobalt has 150 to 250 watt hours per kilogram. Cheaper though, $80 to $100 per kilowatt hour versus 100 to 140 per kilowatt hour. So the lower cost of this ends up resulting in lower levelized cost per kilowatt hour. Nickel manganese cobalt, you have different chemistries here, 811532. And this is pretty straightforward. 80%, 10%, 10%, 80% nickel, 10% manganese, 10% cobalt. You can sort of figure this one out, right? 50% nickel, 30% manganese, 20% cobalt. So when you see an NMC battery with 3 numbers after, these are the percents of the materials. The higher the nickel content, the higher the energy density. But this is subject to thermal runaway. 98% of cathode materials for the lithium iron phosphate, 98% of cathode materials and battery cells are made in China versus for nickel, manganese, cobalt, 60%. Let's talk about degradation. This is sort of the big difference between what EOS is doing and what Fluence is doing. For lithium iron phosphate, the capacity of the battery will degrade over time, degrades with deep cycling, and the higher the charge and discharge rate. So you can get some chargers that will charge a battery very, very quickly. You are slowly destroying that battery by charging it at those very high rates. 1 to 1.5% of the capacity of the battery fades away every year. Deep cycling means you charge it to 100%, you run it down to 0, charge it to 100, run it down to 0. It should be about 80% depth for these to extend the life as much as possible. So that if you actually need 4 hours, you actually have to overbuild the amount of batteries that you have to account for the 80% depth. So if you need 4 hours, you're going to have to put in close to 4.5 to 4.8 hours to make sure that you don't exceed the 80% depth to extend the life of those batteries. So you are overbuilding. Versus what EOS is doing, this is their ticker EOSE, zinc bromine. Their claim, 100% discharge depth, 6,000 cycles, meaning 20 years, and no degradation, either with deep cycling or the passage of time. No degradation. Their duration, they're looking at anywhere from 3 to 12 hours. So going past 4 hours, lithium ion is not really going to be your solution. You're going to need something else, and this is what they're looking at, is this larger segment, which works well if you're going to have extended periods, let's say in a region where there's going to be just a lot of cloud cover for a number of days, and solar is just not going to perform very well, or for a data center that is concerned about potential energy utility outages in their area, would need more than 4 hours, up to 12 hours. So that does provide significant backup power. Let's look at the markets where they play, front of the meter and behind the meter. Fluence really was front of the meter. They have made a pivot to data centers because it's such a lucrative market, but really they play at front of the meter, which is utility scale. And here they sell. They're a systems integrator. They don't run it. They don't own the asset. They sell the asset to either a third party who will then run it as an energy as a service company, or they sell it to the utility. What is the use case? Let's say that I was going to be this third party that buys these batteries as energy as a service. What's the use case for me to buy these? There's got to be something there. There are revenue streams. California really leans towards capacity payments. Utilities have to have some capacity to meet demand at different times of day. So they'll pay, if I own these batteries, they'll pay me a fee, just whether they use the batteries or not, whether they use the energy I have or not. I'm basically, when they give me that fee, I'm basically handing over to them the battery, saying, you get to use it whenever you want. I'll manage the battery itself, but you get to use it whenever you want. You pay me this capacity payment. I also have the ability to arb energy prices. I can charge that battery when rates are low, and if I'm not expected to deliver any capacity to the system, I can then sell some of that power at higher rates. Texas relies more on this. Texas doesn't have capacity payments. As the asset owner, you are arbing energy. But the more that do it, the faster that ARB shrinks. The spread begins to shrink. And then you can get payments for having your battery available for frequency regulation or for spinning reserves. Spinning reserves is middle of the night. Remember, supply has to equal demand. So if you have one facility that is going down, you need something to ramp up very quickly. That's what that would do. So this is revenue streams to the asset owner, plus there is an investment tax credit up to 50% of the installed cost that is in the one big, I'm just going to call it the One Big Act, One Big Beautiful Act, One Big Act, which is different than electricity generation. So solar and wind are going to be grandfathered out within a couple of years. You got to start your project before a certain date, and then within a couple of years it ends. The tax credit for the batteries, I think, extend under this act, extend all the way into 2035. So they're there for a while. So as the purchaser of the battery, I get these huge tax credits. But coming with these tax credits is a creeping requirement to move your supply chain away from what are called problematic countries, China being one of them. So you have to, and there's an extra 10% kicker in there if you have over, I think it's 55% or 60% that is US sourced by a certain date. So that is helping bring the supply chain, or at least mature the supply chain in the US for these materials. I kind of disagree with that approach, but there we are, and I'll tell you in a minute why I disagree with it. As I say here, more batteries, less ARB spread, so one of the big revenue streams eventually will disappear, so you need the investment tax credit to make it worth it, which sort of makes it a subsidized industry, doesn't it? Behind the meter, this is for commercial and industrial. The use case for data centers is quite clear. They can't afford to be down for even a second. It's millions of dollars, probably a minute for being down. So they'll spend the money on having just a redundant system in place. But more than that, it does avoid costs. This is called peak shaving here. It avoids demand charges. So let's say that their demand runs like this, but every now and then they peak and then they come right back down. The utility says, well, because of this, you must pay for this. Even though you only use it in this one little window of time, maybe when you start up or maybe when something happens during the course of the day, you have this peak. You can think more in terms of industrial companies that may start up their equipment at a certain time where it peaks up like that. They have to pay for all of this. They have to pay not just this and then pay an extra fee here. They have to pay for all of this. So they pay for this even though they use this. So by using a battery, they can pay for this and have the battery take care of that. That means they are peak shaving. Demand charges can be 30 to 70% of their utility expense. So if you put batteries in, the payback period, by the way, on something like this is about 6 years. Anywhere from 3 to 6 years, depending on whether you're more closer to 30% or 70% of your utility charge. So on that case, these are lithium ion. You can get 10 years before you degrade the battery down to 80% capacity. Your payback is 3 to 6 years. You get an investment tax credit. It seems to be a no-brainer. So the future, I think the next few years for battery storage in this space makes a lot of sense. In the lithium ion space makes a lot of sense. So Fluence, I think, probably has some good potential in front of it. I'll compare it to Tesla shortly and explain why I think the market would be more accepting of Fluence than they would of Tesla. As far as EOS, it's unproven. Their technology is still unproven at scale at this point. They also have time of use optimization, which is a form of energy arb. Now, somebody in C&I, commercial, industrial, they don't want to get involved in that. you can say, look, you can also do this, and if I'm running a factory, it's like, well, that's nice. I mean, I can avoid my demand charges. That's pretty good, but I don't want to get involved in this. That seems to me like a whole business. Well, there's management software that will take care of that. So the company that installs the battery will also have this operating system, this management software layered on top of that to take advantage of that. So I think, well, okay, if you're going to do it for me, okay, and obviously you're going to get a little cut of that. And you're going to offer maintenance on my battery, that kind of stuff. So now there's a recurring revenue stream on top of that. Isn't that nice? Fluence was and EOS were really looking at front of meter. Both of them have made pivots for data centers because the investment tax credit makes a lot of sense, and because they're easy customers to grab. Let's go through some income statements, balance sheets, cash flow statements for each one. Then we'll look at some other points on each company. We'll start with Fluence, and we'll start with their income statement. Look at revenue. This is an important thing to understand when you're looking at battery storage companies. If you're looking at revenue growth, you're probably looking at the wrong thing. Let's go from 2023, 2.2 billion to 2.7 billion in 2024 to 2.2 billion in 2025. You would say, well, from a revenue perspective, that doesn't sound good. 2025, they're selling pretty much the same as 2023. Is this just not a flat company in terms of growth? Remember, these prices keep coming down and down and down, and Fluence within their contracts has a cost adjustment based on the cost of their input product, the lithium cost. Well, if the price of all of this keeps coming down, then per gigawatt that they install, the revenue keeps coming down. So we can't look at their revenue. The revenue is not telling us the growth in the product that they're selling, because it's tied up with massive deflation in the very price itself. So it doesn't really tell us a lot. Have a look at their gross profit. It's tight. 13 points gross profit. This is not an exciting industry. Tesla is far higher in its gross profit because Tesla is integrated. It captures margin all along the supply chain. But Fluence is a systems integrator. It buys its battery cells from wherever it wants to buy its battery cells. So it doesn't capture that margin. 13 points. It's not a lot to live on. But from 2023, they did 2.2 billion, 140 in gross margin. Here, pretty much in 2025, the same 2.2 billion, but more than double the gross profit, 295. And then, of course, you have all of your expenses on top of that. For 2025, remember, 13 points is not a lot. You're losing money here. You have a loss of 45 million. So total loss per share, 37 cents per share. And this is nice to see that your basic and diluted are the same. You're not facing a whole bunch of dilution. One company we looked at had huge dilution in there, 99 cents, I think 97 cents was their basic, 64 cents was their diluted. Huge amount of dilution in there. Let's move up to their asset, to the balance sheet. Have a look here. Lots of cash, 690 million in cash, restricted cash 23 million. You have trade receivables and unbilled receivables. Their revenues are lumpy. For revenue recognition, there are rules as to when they can recognize revenue, but they do a lot of work on their way to recognizing revenue that contractually they're going to get. So that's why they have this category of unbilled receivables. It's money they're owed, but they can't bill for it yet because it's still unearned revenue. We should see a big amount for unearned revenue. Where is our deferred revenue? Look at that, 640 million. Here's their debt, 300, the big one, 390 million. If we look at their equity, this is total stockholders' equity attributable to Fluence, 430 million. They do have an accumulated deficit in here. And let's just head to their cash flow statement very quickly. just to have a look at share-based compensation. You can see a lot going on. This is changes in operating assets and liabilities. This is working capital accounts. A lot going on here. Above that line, there's our stock-based compensation, 19.5 million. That's not bad. 26.9 dropped to 23.8, dropped to 19.5. That's reasonable. Let's have a look at EOS. Let me drag that onto the screen here. We'll start with their revenues. 9 months ended. We'll focus on the 9 months ended. Revenue 56.2 million. Cost of goods sold 145. So they have negative gross profit right away. So this is a cash burn company. Operating loss 178,000, and then they have a whole bunch of other change in values, change in fair value of warrants, change in fair value of derivatives to a related party. 849,000 loss before income tax. All of this is non-cash. So if we look at the first 6 months, first 9 months, a loss of $6.06 a share, basic and diluted. For the quarter, a loss of almost $5. Let's go to the cash flow statement and see how they're doing on operating activities. $161 million cash burn. Investing activities, also a use of cash, another 30 million here. So it is all from financing. This is the proceeds from a note that was issued, 240 million. Keeps going here for financing. Net cash provided by financing, 214 million. Let's look at their balance sheet. This is where it gets really ugly. We look at their total assets, 328 million. Cash and cash equivalents, only 58 million. They got a cash burn of pretty much that every quarter. 58 million. Restricted cash of 36 million. And let's head down to their liabilities. Keep in mind their total assets are 328 million up here. Total liabilities are 1.4 billion. This is an insolvent company. They have preferred stock sitting in front of the common stock, and total shareholder deficit $2.3 billion. There's nothing there. There's nothing there. And it has a market cap of 4.6 billion. Easy to talk ourselves out of this, to say, oh, well, I would never touch this. But let's look at the problem they're trying to solve and the technology that they have. Lots of companies go through this process where they are really an investment in R&D first before they're an investment in a company. And EOS really is an investment in R&D in a particular type of battery configuration. Okay, we're going to use the top 40 sheets for both Fluence and EOS because I've made a lot of good points in here. I didn't feel like replicating in handwriting on the screen when I said, well, let's just use this. Why do it twice? Point number one, and I have a point to make about this. I said that I would talk about this investment tax credit and why I disagree with it. Fluence has established a defensive moat in the U.S. market by securing a domestic supply chain that meets the One Big Beautiful Act and investment tax credit domestic content bonus requirements, offering a 10% capex advantage to their customers that many foreign competitors cannot match. Well, that's a good thing for Fluence. It's not such a great thing for the American taxpayer. What we're saying here is we could get the Chinese government to subsidize the cost of this for American utility companies, but let's not do that. Let's make the American taxpayers subsidize it as well. If you truly want other countries to pay for it, and you're accusing China of subsidizing its industries, then let it subsidize its industries and take its product. The counter to that is, well, look, we have to, for national security, we have to really develop our own supply channels. But there is evidence, and we'll see it when we look at EOS, there's lots of evidence that says that lithium is not going to be the final destination. It is more likely going to be another battery chemistry or solid state. And if this is not going to be the final destination, why not invest in the technology that will be the final destination and have another government subsidize product for American consumers, as opposed to the American taxpayer subsidizing what is more likely going to be a transitory technology. Enough said about that. I just think that, listen, if you can get it cheaper out of China, get it cheaper out of China and invest in the technology that will displace this, not try to replicate what appears to be a limited technology, right? Siemens and AES pedigree. It was born as a joint venture between Siemens and AES, vendor agnostic software. This is where I think it has an advantage over Tesla. Unlike Tesla, whose software is vertically integrated with its hardware, Fluence's digital arm is vendor agnostic, managing assets from third-party OEMs, which creates a broader total addressable market for its SaaS offerings. Not only that, since it's not vertically integrated, we'll see this a little later on, Fluence can use battery cells from anybody, including solid state. It's not locked in to a technology. It's not locked into a battery chemistry. Once you're vertically integrated, you're locked into that. Fluence is one of the few non-Chinese integrators with a truly global footprint, active deploying gigawatt-scale projects in EMEA, the Americas, and APAC, reducing exposure to policy in any jurisdiction. Data center pivot, a company has aggressively pivoted towards data center power market, securing a pipeline of over 30 gigawatt hours. Now we know how to read that, right? That's not gigawatts, that's gigawatt hours. That's energy capacity. Gigawatt hours in opportunities specifically for hyperscalers who require behind-the-meter backup and power quality solutions. 22 gigawatts of digital assets under management, including third-party assets. That is what we talked about just a little above with its software. It is not a dependent, it's not like an operating system on its own hardware. It's a management system that says, hey, look, you got batteries from somebody else, that's fine. That's fine. We can take care of that. Fluence possesses a proprietary data lake on battery health and grid volatility that fuels its AI bidding algorithms. For AI, you need lots of data. And if their software was limited by just their installations, that would be a slower build, but it's not. Creating a network effect where more data leads to better optimization and higher customer retention. And if that's the case and you have better optimization, then more asset owners, battery asset owners will want to use your software on their batteries, giving you more data, and it becomes a virtuous cycle. In response to industry concerns over thermal runaway, Fluence conducts large-scale fire testing and markets its proprietary safety systems as a premium feature. Long-duration storage readiness, currently focused on lithium-ion. Fluence's modular architecture, this is important, is designed to be technology agnostic, allowing it to integrate emerging LDAS chemistries like solid-state batteries without redesigning its entire platform. Hardware plus service core business model is transitioning from pure hardware sales, lumpy, low margin. We've seen that. Their gross margins are 13 points. To a hardware plus services recurring revenue model where long-term service agreements are attached to nearly every hardware sale. Fluence IQ platform generates high-margin annual recurring revenue, which stabilizes cash flow and commands a higher valuation multiple than hardware integrator. Backlog. Company maintains massive contracted backlog. It was $5.3 billion as of the end of their fiscal 2025, September 30th. $5.3 billion. Keep in mind they do $2.3 billion a year. They got $5.3 billion in backlog. Backlog typically covers 80 to 90% of the forward 12-month revenue guidance. Business is working capital intensive. Analysts must monitor the cash conversion cycle closely. We saw a whole bunch of cash flow adjustments for that on their cash flow statement. Revenue recognition is tied to project milestones, causing lumpiness that analysts should normalize over a rolling 12-month period rather than reacting to quarterly volatility. One way to do that is to adjust the revenue for the level of unbilled receivables. Let's see. Newly introduced SmartStack platform increases energy density to about 7.5 megawatt hours per unit. directly addressing land-constrained markets like UK and California. I'm not going to go through all of these. I think we've hit the big point. The idea behind these is I give you 40 points about a company, market dynamics and competition. Primary competitor SunGrow, primary competitor Tesla. Tesla's Megapack is the main US rival. However, Tesla's black box ecosystem contrasts with Fluence's open architecture approach, appealing to utilities that want more control and data transparency. So there's 40 points here. If you look down in the description box, there is a link that you can click on, that you can leave your email address, and every Friday at 5 we will send you these infographics. So that is the one for Fluence. Let's look at EOS. You may be saying, "Oh, I'm not interested in the EOS. EOS is insolvent. They're nothing I'd want to invest in." Let's think about their alternative chemistry. Utilizes a proprietary zinc hybrid cathode chemistry, decouples its supply chain from the volatility of lithium, cobalt, and nickel. Raw material independence provides a hedge against geopolitical supply shocks and allows for more stable long-term pricing structures compared to lithium ion. Okay, that sounds really great, but what if the market doesn't want it? Oh, great, you can get all that done, right? So it sounds good. You can decouple from those particular markets. Great for the company, but does it provide any value for the end customer? Companies manufacturing deeply rooted in the U.S., allowing its hardware to qualify for the 10% domestic content bonus credit under the Inflation Reduction Act. So does Fluence. So advantage no one on that one, right? Inherently non-flammable, creates no risk of thermal runaway. And that is true on that one. But lithium iron phosphate also has that claim. Temperatures up to 400 degrees Celsius before there's a problem. It's not as if it cannot happen. It's just unlikely to happen. Long duration storage. This is their big thing. This is what they can do that Fluence currently cannot with lithium ion. But remember now, Fluence is agnostic as to the type of cells it puts in its stacks, right? It can put a different chemistry in. It's a systems integrator. It doesn't make the stuff. Long duration storage pure play. EOS is strategically positioned as a pure play provider for the 3 to 12 hour duration market, a segment growing faster than short duration storage due to increasing renewable penetration. Duration flexibility allows customers to address both peak shaving, we understand what that means now, right, and extended capacity requirements with a single asset class. That's its claim. That's where it's trying to go to. That's what it wants to do. Everything else that it has, the alternative chemistry, great for them. Okay, so you can get it in the US, but so can Fluence. Safety driven because of the thermal runaway. You're not going to get it with EOS. You might get it with lithium iron phosphate, but very unlikely. The only advantage is long duration. Operating temperature range. Unlike lithium ion that requires significant HVAC loads to maintain narrow temperature windows, which is true. On those stacks, you do have to have some kind of cooling system. EOS systems operate efficiently between negative 20 and 50 degrees. Reduces balance of system costs and parasitic load, improving the overall round-trip efficiency. Lots of patents. Bankability. $305 million loan guarantee from the Department of Energy loan programs. Data center pivot, so has Fluence. Flagship Z3 Cube is modular, containerized product, so is Fluence. Designed for rapid field deployment, effectively reducing engineering, procurement, construction labor costs, same with Fluence. Small footprints and modularity allow for building block scalability from megawatt to gigawatt, same with Fluence. 100% depth of discharge. That is different chemistry. Capable of 100% depth of discharge without damaging the battery's health or cycle life. A distinct advantage over many lithium chemistries that must reserve capacity to prevent degradation. Flat degradation curve. Superior degradation profile where the battery retains high capacity over 20 years with minimal fade. after initial break-in period. Recyclability and sustainability. So is Fluence. No HVAC requirements. That is an advantage that they have here. They have their own operating system, proprietary battery management and analytics software that provides granular visibility into asset health. Digital layer facilitates predictive maintenance and optimizes dispatch strategies, creating a potential recurring revenue stream from software services. Remember, Fluence's operating system is battery agnostic. It will work with anyone's, including EOS. And I'm not going to read through everything here. I'll let you read through this yourself. If you click on the link and you leave your email name, I think you'll get these as well. Even though we send them out Friday at 4, any new person that signs up also gets them as well. So you'll have these as well. One last point I'll leave you with is I've designed these documents such that you can then produce your own research report. There are 40 points here. These points are prompts. So you can go to your favorite LLM and you can type in, tell me more about quote, unquote, and you can just put the whole text in the quote. So out of 40 points, as you're reading through, you might say, I get this, I get that. I'd like to know more about this or more about that. Out of the 40, there might be 14 points where you say, tell me more about this. Well, you just use your LLM and it'll write the report that you need for yourself. This way here, everyone can just develop their own report as opposed to me just writing one, trying to please everybody. Why not just in this world of LLMs, why produce research reports? Why not produce research prompts?